everyone. Ryan Begley here with the McIntyre Financial Report. I am joined today by Britton Begley, the attorney here at McIntyre Elder Law.
That's right.
All right. So I was talking to you today because I was in Virginia over the weekend. Awesome place, by the way. But I was in Virginia. These ladies, I overheard them talking because we were in the same line, very close. I wasn't trying to eavesdrop, but I could hear them speaking. And they were talking about this gentleman. He had a life insurance policy, and he signed in a beneficiary to that life insurance policy. And I know how they work because I do life insurance, right? And I know sometimes that happened in this case, and sometimes this does happen, that individuals will assign a beneficiary, and that beneficiary will die, and they don't have a contingency.
Yeah.
So therefore, it goes to their estate. Well, this individual, his estate was decently large, but he had some medical bills can pile up so much that it wiped out his whole estate.
Yeah.
So even his beneficiary, his whole legacy was pretty much wiped out by medical bills. And even his insurance policy was wiped out by medical bills because the beneficiary the money went to his estate.
Right. So it had to go through probate. And then in probate, these medical bills, they made claims.
Yeah.
And because they made claims, they get paid first before any of the heirs do. And so it wiped out his whole estate before the heirs got anything.
Yeah. And I was like, wow. In my head, I was thinking, what would be a good idea is to put that life insurance policy into a trust, because I'm not sure, I don't know this, but do trusts die?
Trusts do not die unless you set them up to die, right? Okay. Unless you kill them, they do not die. That's right. They're a legal entity that you set up, and if you set them up, you can set them up for a term of years. But essentially, there is a death point in North Carolina for a trust. The maximum term for a trust in North Carolina is 300 years. But essentially, if it lasts 300 years with respect to most mortal beings, that's not dying, right?
Yeah.
And so
just a few Illuminati and wizards.
Yeah, right. Exactly.
Just a few of that.
Tom Cruise and some of those people.
Yeah.
Anyway.
Those lizard men.
That's right. That's right. So with that being said, all you have to do is start another trust after that 300 years. But most people don't think 300 years ahead. So anyway,
it'd be kind of good for them to. A lot of people think 50 years ahead.
I encourage people to think about what your legacy is going to be, hundreds of years from now, because with something like a trust, you can actually set an impact, right, for generations.
Yeah, you can impact the world.
Yeah, absolutely.
And a lot of people don't think that, but if, let's say you have a family of 13 people, and like our father had 13 people, brothers and sisters.
Right.
I don't know how many of them are dead now, but if they all had life insurance and put it into that trust for the family,
right,
that'd be a pretty wealthy trust right now.
That's right. right. And it could help every generation after that.
Yeah.
And
subsidize college, do all that, pay for things.
And if those folks wanted to get money out of the trust, they have to do a life insurance policy back to the trust.
Yeah, exactly.
And so that's what generational wealth is built on, is a strategy like that. So that's brilliant. But just getting back to the trust itself, putting a life insurance policy into a trust, or leaving the trust as the beneficiary to the life insurance policy it's a brilliant idea, because like you said, trust can't die, or it doesn't die for 300 years, right? So you can set a beneficiary, you can set contingencies.
Yeah, it's definitely going to outlive you.
That's right. Yeah. But here's the thing. Here's the question, that a lot of people don't think about is, let's say I name somebody as my beneficiary in a life insurance policy, and they pass away, and maybe I have a contingency. Well, what if that contingency is a special needs individual?
Oh, yeah.
What if that contingency is a minor? Or what if that contingency is just not that responsible of an individual, right? They're going to blow it on a Maserati, right? Okay. And I want to make sure they pay for college, they use it for retirement, whatever it is.
Chad the knucklehead.
That's right.
That's right.
That's right. There's always one in every family.
One, yeah.
That's right. Always one knucklehead. So if you decide to leave insurance to a knucklehead, which, we love them too, right? Or if we leave insurance to somebody who has some type of means-tested government benefit, where if they inherit it, if they inherit that life insurance is going to kick them out of that benefit, which is a lifetime benefit, very hard to get, so you want to stay in that.
Yeah.
It could go into a special trust for them, and what you first have to do is either have the life insurance policy in the trust, or leave it to a trust. So the trust acts as a filter for that money, and people don't think about this sometimes too. Even if you're leaving it to children, these children are responsible. Okay, maybe you want to say, look, I know you're responsible, but I want to still have a hand outside the grave here. Okay, hand on the wheel outside the grave. So when I die, I'm going to give you a certain amount of life insurance, leave it over. A certain amount is going to be available to you immediately, but I want you to have a good retirement. I want you to know, have that peace of mind that you're going to have a good retirement. So let's say I'm leaving you $100,000, you get $25,000 immediately, right? That's there for you because you're sad that I'm dead. So there you go, right? But the other 75,000 is going to be invested. It's going to grow in a retirement fund for you that you can only access when you retire officially.
Yeah, like age 59 and a half.
Let's not do a 65, right? 59 and a half. So in that regard, a trust can act as this really awesome filter for these life insurance policies.
So I'm just going to reiterate just a little bit because and make sure I understand it too. So you're saying that, because I know there's limits to insurance policies.
Yes.
I know that it's an insurance contract, there's limits, there's beneficiaries, but there's limits what you can do to it. But if you put it into a trust, that money becomes extremely flexible, and now you get to tailor it to whatever you want as that person. Even when you die, beyond the grave, you can kind of dictate what happens with that money.
Well, think about this. I mean, a life insurance policy is a contract, right? So it's a contract between the insured and the or the owner of the insured and the life insurance company. So the life insurance company is not going to say, hey, we'll stick around after this person dies and we'll dole out the money, we'll control it. They're like, no, we're not going to have liability.
Unless you pay extra for like a spendthrift or something like that. And so that could be an add-on to something that it could be more money a month.
That's right. But it's very limited as to what they'll do. The actual life insurance company will do. So they won't act as like a trustee for that money. They really just want to pay it out and be done with it. Right. And which is not a bad thing. It makes sense. It's not their job. They just want to pay.
Oh, it's a good thing in most cases because you just want the money and them to stay out of it.
Exactly. Yeah. So, but if it's your policy, you're leaving it behind, or you're wanting to make sure that the money goes in a certain way, then you have the power to do that, and a trust is a great way to do it. Because there's lots of things that you leave behind that you can't put stipulations on, like a deed. That you have very limited stipulations to put on a deed. I mean, heck, a contract for a sale of my home. What if I sold you my home and I decide to finance it myself, where you pay me payments? Okay. Well, if I make the payments payable to my trust and I die, well, my trust is still getting it because my trust is still alive. But if I make the payments payable to myself and I die, well, that might have to go through probate and have to be paid to the estate, and that runs through probate, and you have to pay all the claims with that money until you get to the heirs. It can be a mess, right? Same thing, though, with the life insurance policy is that to avoid it ever going through probate, because life insurance automatically doesn't go through probate, which is a great feature of life insurance. It is. And it typically stays away from any creditors, right? Other than if it has to go to someone's estate, you leave it to a trust, go straight to the trust, and you can control what happens to it after that.
And that prevents it. And you could even, I know you can, but you could even go like, okay, if Martha dies, then it goes to the
That's
trust.
right.
You don't have to do it as the first beneficiary.
You can have it as a contingent beneficiary, sure.
And sorry, Martha, I didn't mean to put you down like that. But
no Marthas were harmed in this video.
No Marthas. Isn't that like Superman's mom's name? Is that Martha? I don't know if it's Martha. I think he said something about it like in the movie, but okay.
Yeah, we'll go with Martha.
Back on topic. We'll go with Martha. Well, because I think it's Batman and Superman's. I think it's Batman's and Superman's mom's name. They're both Martha, and that's why they got together. Anyhow, so it's really
lazy writing there.
Yeah, I know, for real. It's like someone's like, it doesn't deal with Martha. You're like, Bruce Wayne, Clark Kent. His real name's Kal-El, by the way. I'm a little bit of a nerd. But so it behooves you as an individual to.
That's a word to use,
yeah. Yeah, it's a good word. It behooves you.
It's really bringing out that medieval vernacular.
I know.
Wherefore it shall behoove you.
Yeah, speaking old English here in a second. Right. But it would really be advantageous if to an individual if they, because we're all about estate planning, saving legacies. I'm about I work with you to do that. You know. And we make these plans all the time for people. And when I heard that in Virginia, I was like, this is sad. Because if she would have just came to you, if the individual would have came to you and you could have talked to them, you could have saved them all their money. You know
That's
what
right.
I mean?
Well, you know, I'm sitting here thinking as you're saying that, like, I hear all the time, you know, whenever I'm giving either a consultation seminar or doing one of these videos and getting comments, and you hear people saying, like, my God, I had never heard of this, right? I've never heard of these options or whatever. And number one, it's a sad thing. It's not out there a lot. That's why we're doing these things, right? Trying to scream it from the rooftops, like, hey, these options are out there. And the thing is that, I mean, no one teaches you this stuff, right?
Yeah.
No one puts it out there, because usually, you know, what you have is this idea of you have to come to me for you to know, okay?
Yeah.
But what we want to do is we want people to be informed, because these things are important. I mean, I would not want to kick my beneficiary out of some benefit that they could get for the rest of their life.
Oh, yeah.
I would not want it to go to somebody who's going to blow it. I would not want to get it to a minor and have their irresponsible parent get a hold of it and blow it. I wouldn't want it to, you know, go and it not be available for them for what I hope it will be available for, right? And sometimes it's the reason why we do insurance. Insurance is an amazing thing. It's one of the best things that we have as an actual product in the United States. And the thing is if you utilize it right, if you get with the right person and do the right plan and to do that insurance, it is incredibly valuable. But that's not enough, right? You need to make sure that it's protected. You have this diamond, this hope diamond, this jewel, right?
Yeah.
That you need to make sure it's protected because of how valuable insurance is. So I guess that's two things we want to emphasize here. Is number one, the value of insurance in general is just so huge.
Oh, yeah, it's amazing.
I mean, you can pay for your family's education. You can invest. You can be your own bank. You can do all these things. It's very flexible. But the thing is that just having the insurance, just owning it, doesn't mean it's necessarily protected.
Yeah, it still holds you vulnerable.
That's
to
right.
vultures.
That's right. Or long-term care.
Oh, my Lord. Yeah, don't get me started on long-term care.
Yeah.
We've done videos on this, and we'll continue to do videos on this because we really need to educate people about long-term care.
That's right. So the cost of long-term care is huge. 70% of individuals end up needing long-term care. God forbid they don't have a long-term care insurance policy, or if the long-term care insurance policy doesn't cover the full cost of care. You don't want to be exposed and have your life insurance where it has to be cashed out, spent down, something like that. You want to be able to have that protected and still qualify for
And what's happening now, if you look up Washington, I haven't looked up this specific law, I've read about it, but Washington's starting to pass, Washington, D.C. is starting to pass
so at the federal level,
a long-term care. Like you have to, it's a state sponsored or whatever, or federally sponsored or whatever. I haven't really looked at the full thing yet, but I just saw it on our insurance agents, the brokers. They send you like things like, hey, be aware of this is happening.
Yeah.
I just got it today. It is going to be pushing people to start purchasing it, and so people are mass flooding to the private sector because it's cheaper.
Gotcha.
And it's going to be a lot better for that coverage. Yeah. Because you're going to have to start putting it in. They might start trying to put it like in your state, maybe add it to your payroll or taxes. Right. Which, you kind of been paying for it your whole life anyway. I don't know why you're paying for it a second time.
So basically what they're doing is they're doing it at the federal level, handing over states and saying, hey, put this Band-Aid over this bullet hole. And people are saying, look, we don't think that that's going to be good enough for us. We're going to go seek other products to help make sure we're actually protected.
Yeah, and these products, long-term care insurance is awesome. Yeah. Like it saves, like we see it when we're doing consultations. We see elderly people every day.
Night and day difference. Night and day difference. If you have long-term care insurance to cover the cost of long-term care, you're in a way different boat than if you don't have it and you need care.
Yeah, every single time I talk to an individual that's over 60 years old, and they're like, I wish I would have known about this when I was in my 40s or 50s. Why didn't I know about this?
That's right.
I wish I would. Now it's going to cost me way more money.
Right. Still worth it, but it'll cost you way more money. And the thing is, you start early, the premiums
I'm not
are
even
lower.
saying the premiums. I'm talking about the cost of care is going to cost them so much money. Because we saved a lady the other day. She was paying what was like $5,000-$6,000 a month. Yeah. For her, and that was like with help and all that stuff. Yeah. She was paying that, and you saved her from that.
Yeah. So in long-term care, that wasn't a long-term care insurance premium. That would have been
not
awful. No, we'd have to report that. Yeah. So we could go on and on about the cost of long-term care. We could go on and on about the value of life insurance or insurance in general. But what we want to emphasize is that if you got insurance, you're not done yet. make sure everything is protected. And that goes along with your home. That goes along with any valuable asset that you have. A lot of people understand that they need to protect the home. They get all over that. A lot of people don't understand that their IRAs, 401ks, and life insurance.
Yeah, you put your physical money that you have in a safe at your house. Why wouldn't you put the money like insurance money in a safe like a trust?
That's right, a legal safe. That's right. So, thank you.
Yeah.
This is awesome. This is good.
Yeah, if you want to give us a call, you can give us a call. What's your number, Brent?
704-259-7040, and you can sit down with me for an hour for free. We give free consultations to anybody who clicks and gives us a like and comments, and we'd love to hear your feedback, your questions.
Yeah.
We appreciate all that.
Engage with us. We don't mind at all.
Yeah.